Welcome to OpenECRI's Trader Training. My name is Toby Gennaro. What I'll be talking about today is trading with a strategy and how it can improve your probability of success in the markets. Let's take a look. A trading strategy helps to create an edge in the markets, and that strategy is going to be made up of a set of rules defined in advance that will represent the edge in the market. And with that edge, we'll be able to identify the market characteristics or patterns that will reoccur frequently with a high probability of success. So it's very simple. We're looking back at the past and then forecasting what will likely happen in the future. And I say likely because we're never certain on any particular trade. Anything can happen in the markets, so we never know for certain what will happen on any one particular trade. I always get that question in webinar sessions. Someone will invariably ask, how do you know that will happen? And the answer is I don't, and that's why I manage risk first, because all I know is that there is a high probability of a favorable outcome reoccurring. But as a trader, that's all I have is a probability, not certainty, and that's why we manage risk. So in addition to predefined rules and high probabilities, we have flawless execution, which enables us to establish consistency over a large sample set of trades. Now, what does the strategy consist of? Well, it consists of a list of ingredients and essentially a recipe or a method for utilizing those ingredients. If all we have are technical indicators, they're going to be useless to us until we have a method of putting them all together and formulating a strategy to gain an edge in the markets. Let's spend some time to help you understand what a trading strategy looks like. This strategy is a trend following strategy, simply meaning that you locate a strong trending market and find a safe entry, stop, and profitable exit target. What we're going to be doing with this strategy is essentially buying and selling pullbacks into the moving averages. We'll be trading with the agreement of multiple time frame trends to find the same setup on at least two charts. The more confirmation we have from several different time frames, the higher probability the trade setup will be. Since this is a universal strategy, this setup is great for both swing trading or intraday trading. It's purely a matter of the time frames that you're working with that give you a longer or shorter time horizon on the trade. Let's take a quick look at the ingredients needed for this trade. A strong trend is a must. It will be key for you to identify a trending market with an optimal chart structure before proceeding with this trade setup. In this optimal chart structure, what we're looking for besides optimal price action are a specific pattern in the moving averages. We will need to see the moving averages trending well and in order for the proper pattern structure for the 10 period, the 20, the 50, and the 200 period moving averages. In addition, we'll need to see the price action making successive higher highs and higher lows, or vice versa for a downtrend, with no erratic price behavior, just nice, predictable, smooth flowing candles. We want to see the price action pulling back into the 10 and 20 period moving averages in a nice controlled way, signifying that this trend contains consistent, predictable buying or selling pressure. The setup signal on this trade will be a small entry candle on the higher time frame for our precise entry and stop loss. Please keep in mind that this is a strategy overview. Not all the strategy details are included here. If you're interested in learning more about trading strategies, check out the OpenECRI website under Education and look for other trading videos and webinars, or you can call customer service for more information and educational events. Thanks for watching OpenECRI's Trading Education.